Hi, everyone, and thank you for joining us. We're glad to have you for our webinar today. I'm Kristen McCalla, and I'm going to go over a few housekeeping items before I turn it over to our presenters for the program today. Your audio should stream automatically upon entry through your computer speakers. If you cannot stream your audio, please click on this phone icon I have highlighted here on the screen, and a dial-in phone number will be sent to you. We also encourage you to send us questions through the Q&A feature of the webinar software by clicking the Q&A button at the top of the screen and then typing your question down below. You can also download a copy of the PowerPoint slides by clicking the File button and then selecting Save as a PDF type. And with that, I will pass it off to Mr. Rick Eckman.
Right, thanks, Kristen. And thanks, everybody, for joining us today. We have a terrific program that will help you understand the advantages of the new Fintech National Bank Charter, but more importantly, the process you will need to go through to apply for and hopefully be approved for a charter. The OCC did not issue a charter at all in the past few years and has only issued 6 since 2012, a reflection of the economy and the consolidation in the industry. Our panel today has many years of experience at the OCC dealing as lawyers with the chartering issues and know how the regulators approach the chartering process. We also welcome George Popescu, who is the publisher of the well-read online publication Lending Times, which focuses exclusively on the fintech industry. George wrote an article recently analyzing the cost benefits of obtaining an OCC fintech charter versus adopting a bank partnership model, and we'll discuss his analysis in more depth. We hope to leave some time at the end for questions, so let's get started. First, my colleague Greg Rubis will go through the advantages of an OCC charter and take us through the process required to consider, apply for, and obtain a charter, including the post-chartering process. Next, Mark Daverton will go through a deeper dive on how the OCC approaches the chartering process, what are some of the pitfalls to avoid, and a look at what happened in a failed, newly chartered national bank and the lessons that we can learn from that. So, Greg, take us away.
Good day, everybody. So perhaps before we get into the mechanics of how to file an application, we ought to talk about why you would be thinking about that. And so we have basically in an OCC rule and through history, what it is that a bank is. Now, the OCC regulates institutions that engage in the business of banking, and the business of banking is an evolving concept. There have been times as recently as last year where trading copper was in the business of banking, and now copper is not considered to be the business of banking. So again, through time, this evolves. Of course, there are statutory provisions that specifically prohibit national banks from doing certain things, and there are other statutes that expressly authorize them to engage in other types of activities. But basically, the three concepts for a bank are that it either or engages in more than one of the following. Either receives deposits, it pays checks, or it lends money. So if the fintech entity has none of those or nothing that can be construed as falling within any of those or at least one of those, then it really could not apply for the charter, because this charter is for a national bank. And so it will be regulated as a national bank, and because of that, the only authority that the OCC has to regulate it stems from its existence as a bank. And you may have heard that there have been numerous criticisms of the paper that the OCC issued. It's come from certain state regulators and also from certain senators that have challenged whether the OCC has authority to create such a charter or whether they're in the best position to regulate such entities. But those are more ancillary. We can perhaps get into those later. The reason why we have those types of criticisms is because there are some that do perceive this charter could be a big advantage. And the reasons for that advantage or advantages would be because, pursuant to federal statutory authority, you can export your interest rates from your home state. So if you are in a state such as Delaware or South Dakota, which has a very high interest rate that's permitted, then you would be able to use that interest rate regardless of where the loans originated. It could be in Nebraska or New York, and New York would not be able to control what the interest rate is for those loans. And this is considered to be a very big advantage, but we should keep in mind that we're talking about the home state. So unlike a corporation that can have its operations in New York but form under Delaware law and have basically just a drop box or an agent for service in Delaware, this statutory requirement is that you actually have your home state there. You have to be based in the state in which you are going to use the exportation of interest rates advantage.
I will just jump in here to say that there have been a number of banks that want to use Delaware law to export rates, and when you start thinking about what is a home state, you don't have to think that you have to have a big office building and have lots of employees there. TD Bank, for instance, has its home state in Delaware and operates from a branch on Naaman's Road. So I don't want you to get the wrong impression as to how you would create the home state for purposes of interest exportation.
So in addition to that, you have also preemption of many state laws. And so one of the significant advantages is that you would be able, as a Fintech national bank, to have one set of regulations or statutes that apply to you and exclude, in certain areas, all of the state laws that might otherwise apply. So if you, for example, would operate in a number of states, instead of having to comply with each state's certain types of laws, that you would be able to avoid that. Now, the way you can preempt state law by means of the federal statute is that if the state law would have a discriminatory effect on a bank, a national bank, and that effect would not be felt by a state bank, then that law is preempted. So this covers such things as the interest rate, as we talked about, and other things. It does not cover all laws, though. So, for example, if someone punches someone in your branch or in your office, then state law governs that. You can't run away from state law and say, well, we're governed only by federal law. And also, if there's a federal statute that directly says that state law is preempted, then of course, then a federally chartered national bank, a national bank would also have advantage of that. And of course, as we said, other states' laws continue to apply. So let's say now that you have not been become afraid of considering whether to apply for a charter, you can take the next step, which is to plan and actually meet with the people at the OCC on a non-binding basis and in a non-public way. And this would enable you to find out more about what you would need, what the OCC would want you to have for your charter and your articles of association so that you conduct your business. So the first thing that they would probably want to discuss with you is your business plan. It does not mean that when you go to meet with the OCC, they actually want you to physically come to an office. And they would like for you to bring with you your chief executive officer and as many members of the management team and the organizers or the board of directors as you can, but it's not necessary that you do so. And you basically are going to go into the room with the OCC people, typically licensing people, and you're going to discuss what it is that you think your business will do on a summary basis. We'll talk later about what has to be in the business plan, but when you present to them, it basically has to be an idea that would enable the OCC to say, yes, this is a bank activity, and we could charter it, and also that there's not undue risk here, so that if we allowed you to embark on this endeavor, you would, or you could be a profitable endeavor, and also that it meets the other requirements of the OCC, including that it meets the financial needs, or it better meets the financial needs of those people in the places where you will be operating. So in addition to providing the biographical information and talking about who is going to be on your management team, you're going to have to discuss whether you're going to have affiliated companies and whether you and your affiliates are going to engage in any transactions together. And if so, the OCC will be looking for you to describe to them how you will address those, because under federal law, you cannot engage in insider transactions that act to the detriment of the national bank. And so you may also be asked to provide a conflicts of interest summary and to discuss all the nature of relationships between the proposed national bank and affiliated entities. Now, in addition to those, you will also have to discuss capital and liquidity and what you're going to do in order to bring this entity into the status of a national bank, meaning how much capital you have. So a threshold minimum, which is not the same for other national banks, is a Tier 1 leverage ratio of at least 8%. And then, of course, if you're going to raise money in order to fund the operations, then you're going to have to discuss that with them. If you will be using a private placement memorandum, then you should be aware that the OCC will be the entity that regulates the disclosure that's provided to investors. If you decide that you wish, for some reason, to have a holding company, which might be a bank holding company, and you wanted to file that with the Securities and Exchange Commission, then their securities laws would obtain. You would follow those rules. The OCC and the SEC rules are, by statute, supposed to be substantially similar, but there are some differences, but we won't focus on that at this meeting. Now, going back to what we were talking about, the meeting that you're having with the OCC is non-public. You can say what you want, although whatever you say, they may remember. And if it differs from what your documents state when you file your application, they might raise comments about that. The other thing that you should remember is you can have the meeting with them at any time. The OCC is very amenable to having entities that want to be chartered by the OCC come and meet with them. They welcome those meetings, and there's no time limit from the time that you meet with them to the time when you must file your application. So when you're ready to file the application, which is also a form that is available on the OCC website, it consists of approximately 17 pages, but most people find that once they've prepared it, it's substantially longer than that. There's a public notice requirement that goes out, and in the public notice requirement, you, the entity, and the notice itself will invite members of the public to comment on your application. If there are a sufficient number of comments, or the OCC decides that this might be an area of public interest, it could even decide to hold a public meeting, in which case your application and when anyone else thinks about it would be present, would happen. You would see that, you would hear it, you would feel it. When you file your application, it's going to have many specific requirements. Again, if you look at the application itself, you'll have to identify each of the directors and the chief executive officer. If you do not have a chief executive officer, then the application will not go very far. If you have a CEO that's currently working somewhere else and he or she would rather not have their name associated with the endeavor because their current employer might be upset by that fact, then there are ways to protect the identity of the CEO while nonetheless providing the OCC with that information. More detailed financial and biographical information is required for each of your executive officers and for your proposed directors. This includes allowing the OCC to ask the IRS about any problems with your tax filings. It enables the FBI to see whether your fingerprints match any others who have had criminal records, and you will also provide them with basically a balance sheet of all of your assets. And then you will sign a certification saying that if you did not provide all the information, that could be a basis for the OCC to seek to have you prosecuted criminally, because providing inaccurate information to the OCC is itself a crime under 18 U.S.C. Section 1001. In addition, you'll have to specify where you think your operations will be based, and if you do not have a specific address because you haven't signed a lease or you're unwilling to sign a lease until you have more certainty, then you have to at least give them a vicinity where it would typically be within a certain city that you've identified. As we talked before, the business plan will be part of that, and the business plan will have not only a summary and a description of the business, but it will have to go into detail into your marketing plan and how the directors and officers are going to fit into that marketing plan. You're also going to have to provide details about your proposed record system, your management systems and controls, and how you will control the operations so there's no risk of the lower risk of the institution having to seek receivership or the equivalent of bankruptcy. You also have to provide a financial management plan which will detail your capital and earnings that you believe you will have. You have to address liquidity, funds management, and sensitivity to interest rate risk, and also credit risk. Now, some of this information we might imagine could be sensitive. It might be why you are going to be distinguished from your competitors and what your competitive advantage is. You may not wish for everyone to be able to see what that is. So when you are preparing to file your application, you'll seek confidential treatment of certain parts of your business plan, if not the whole business plan. And this will restrict access. In addition to this, although you're already providing financial information about your directors and your officers, you're going to have to provide compensation information. How much do you propose to pay them? And the OCC will look at this and try to determine whether this compensation is excessive or appropriate, and they will also look at your proposed capital structure. And so if they see different tranches of stock or the possibility of different types of preferred stocks that could be issued, this may raise significant concerns from them. The OCC is accustomed to seeing national banks. The structures of national banks from the capital perspective are relatively simpler than many Fintech companies. In addition to what you've already put in that application, it will also have to include an insider transaction policy, and you'll have to describe any of the possible connections between you and your affiliates and how the bank will deal with those and whether it is fair to the bank for each and every one of those transactions to be with the affiliate. You should know that once you file your application, clock starts to run. Chiefly that the OCC will endeavor to get you comments within 120 days, but to typically decide the 120 days from the date that your application is deemed to be complete. And your application is not deemed to be complete if the OCC asks you questions and asks you to provide additional information to make your application complete. At a certain time, God willing, your application will be complete, and the OCC will send you a letter that informs you of that fact. The OCC will then send out a team of at least one person, or perhaps more, to conduct a field investigation for what you physically have so far. So they will be looking for the types of things that the OCC will issue comments on about your application. Remember, up to this time, all you were endeavoring to do was to finalize your application so that it would be deemed complete. And so now the OCC has its opportunity to ask you about your chances of success, how you will ensure that the entity will engage in safe and sound operation, and how you will promote and provide fair access, financial inclusion, and protect your communities and your customers, and how you'll treat them fairly, and how your enterprise will have adequate capital for your proposed risk, which you will also explain to them. They also have a presumption against having entities promise that they will raise capital in the future. The OCC and the other banking regulators typically want it up front. If your application is deemed approved, you will get the letter. You will have then 12 months to raise capital if you wish, and 18 months, this is again from the date of approval, to open your bank. It's possible to get an extension, but the OCC general presumption is if you can't open a bank within 18 months, you probably never would. And so then the OCC goes through other operational aspects of your entity and seeks to ensure that you actually have or are ready to sign an operating agreement with the OCC, business plans, and that your capital structures, corporate governance, all your internal controls are basically in place, and all you need to do is to start. And then I think we'll do is skip over the organizational phase, because these are things that we've talked about before, which is basically you have to be able to show that you have an operating bank, that you have an audit system, you have meetings, and that you will have an external audit for at least 3 years, and that you have appropriate insurance in place. After the OCC examines your operation, determines that you have what you need, they will issue an approval, and you will be able to open. I think we'll say just a few more things, and that is, even if you will not have deposit insurance, you will still have to comply with some aspects of the Community Reinvestment Act. We labeled it here CRA Light, and that means you will still have to show how what your operation does is not solely just a profit generator, but that you're actually helping people in the community.
Okay. Mark, do you want to take us through the post-op opening activities of the bank and kind of give us a deeper dive on some of the things that Greg has covered?
Yes, I'd be glad to. So, so one of the things that you want to really keep in mind here is that there really is no such thing as an OCC Fintech charter per se. What the OCC is really talking about here is an exercise of supervisory discretion. What they've indicated is that under certain circumstances, they're willing to accept charter applications from fintech companies, including those companies that have limited activities. And the way that those activities become limited is not by operation of law, but it's a self-limitation. The bank's articles of association limit the activities, and then the OCC, in turn, imposes certain conditions on the approval of the charter, which makes those self-imposed conditions have the force of law. Along those lines, there's an important statute as part of the Federal Deposit Insurance Act that gives those conditions the same force and effect as a cease and desist order would have. So what would be some of the conditions that might be imposed? Well, one of the most important things would be the activity restrictions. As I mentioned, those activities restrictions are both self-imposed, but then in turn become conditions for the approval of the charter. They're important for one very key reason, and that's that unlike certain special purpose banks that are common today, credit card banks, banks that are trust and fiduciary banks, these banks would not be recognized as having a Bank Holding Company Act exception. The Bank Holding Company Act applies to any person who directly or indirectly owns or controls 25% of the voting securities of a bank, or has the ability to elect the majority of the board of directors, or otherwise exercises a controlling influence over the management or policies of the bank. So very important distinction that when you think about these special purpose fintech institutions that may come into being, they would not have a Bank Holding Company Act exemption status. So what makes a bank subject to bank holding company? Well, any bank that has insured deposits is automatically a bank that would be subject to Bank Holding Company Act. In addition, any bank that both accepts demand deposits and makes commercial loans would be a bank subject to Bank Holding Company Act. So why does all that matter? Well, if you're a party that's investing, say providing seed money in a fintech company that's seeking to become a bank, it matters a great deal whether or not that company would now be a form of a bank that would make that investor potentially subject to a bank holding company. If you are a bank holding company, you're not only subject to examination by the Federal Reserve Board, but there are also activity restrictions that apply to any bank holding company. It's a very big deal. So what are some of the other approval conditions? Well, one thing you would definitely expect is that the OCC would require some amount of capital in excess of the minimum amounts that are required by the OCC's capital rule, which is found at 12 CFR Part 3. The OCC employs a risk-based capital methodology. The amount of capital is based on the type of asset that you hold. In addition, it's not uncommon for a new bank for the OCC to require additional capital based on some percentage of managed assets of the institution. Another key condition, which is huge and why I don't have more points on this slide, is that anything in your business plan is going to become a condition of your approval. What that means is that if you want to make any significant deviation from that business plan, you're going to have to seek a no objection approval from the OCC. Very important thing to keep in mind, because if you're looking to perhaps adapt your business plan rapidly over the next few years because you're in sort of a startup mode, then the fact that you would have to seek prior approval for any significant deviation from a written 3-year plan may not be something that would be attractive. In addition, a very common condition for any bank, not just for the kind of banks that we're talking about, the OCC is going to take a very close look at your information security architecture, may require an information security review to be performed by a third party as a condition of approval. Along those lines, one of the things to keep in mind is that the OCC has a number of bulletins. I'll review some of those later on that deal specifically with things like, the internet activities of banks and the special information security requirements that apply to that activity. Next, the contingency funding plan. And this one is very critical because one of the things that the OCC really stresses when they look at any bank is the diversification of risk. Well, here we're talking about a bank that's likely to be a monoline bank, perhaps only engaged in lending or only engaged in payment activities. And so the diversification of the risk is likely to be with respect to funding, the diversification in terms of sources of available funding to be very important. Your contingency funding plan will be expected to address what would happen in the event of a liquidity crisis where, due to unforeseen events, maybe a downturn in the market, unexpectedly poor performance of loans, if you're a lending institution, you now need to seek immediate funding. Where would that funding come from? Who would provide it? What would the institution's borrowing capacity be, et cetera? All that would have to be part of your plan. Next, I strongly would expect that the OCC would expect a robust risk management plan for modeling. About 4 or 5 years ago, actually 2011, the OCC adopted a bulletin that has very extensive guidance for model management from cradle to grave. It addresses the development, the use, the validation, and the retirement of models and the expectations for periodic testing. So those would be things that I would expect to be part of any plan, regardless of the nature of the activities of the bank. So I mentioned before that what we're talking about here is a little different than some of the other special purpose banks that exist today. So special purpose credit card banks and trust banks, well those are recognized in the Bank Holding Company Act as exempt as a result of something called the Competitive Equality Banking Act. And the terms and conditions of those Bank Holding Company Act exemptions dictate in part what those banks can and can't do. So, for example, a special purpose credit card bank can only accept deposits in amounts of $100,000 or greater. A trust bank does not, by statute, in order to be exempt, can't have access to the Federal Reserve discount window. If you're familiar with those exemptions, put them aside when you're thinking about a Fintech institution seeking a charter, because they wouldn't apply unless the Fintech bank chose to become, say, a credit card bank, in which case they wouldn't need the OCC's proposal to do that. They could do that today. So the other thing I'll mention here is that, well, I already mentioned it, that the conditions that are imposed on the bank, you're going to have to live with them because they're going to be part of your business plan and they're going to be enforceable, again, with the same force and effect as a consent order might have.
So, Mark, the criticisms that some of the regulators, state regulators, and some members of the Senate about the power of the OCC to grant a FinTech charter, I think are misplaced, because it seems to me that by operating or granting, these charters with limited powers, that's a voluntary act on the part of the applicant, and they would have the power to accept those, and so I find those criticisms to be a little bit misplaced.
Yes, I find those criticisms to be a bit baffling in that, again, there is no such thing as a FinTech charter. The OCC knows that they don't have the authority to make new law. They can't create a new charter. Congress would have to do that. It really is just a regular national bank charter with imposed conditions, and there's nothing new or unique about that at all. The only thing that would be different here is that the OCC has indicated in advance that they're willing to entertain applications from applicants in this industry, and they've solicited public feedback as to whether or not that's a good idea and what the impacts may be. So, again, really nothing new here at all. It would be fully within the OCC's powers to charter one of these institutions. So let's talk for a moment about this business plan. Any new bank has to have what the OCC describes in their FinTech proposal is a robust and well-developed business plan. It has to cover at least 3 years. And over that 3-year period, you have to forecast what market demand, economic conditions may be, et cetera. Expect, and I'll get into this a little bit later, that you're not going to be allowed a lot of discretion in making any material departure from the plan. So once again, I'll emphasize that if the idea of a plan doesn't appeal to your company, then you wouldn't want to go this route because, again, it's going to be something that you're going to be held to. Now, in defining the bank's products and services and market, well, one of the key things that's emphasized in the proposal is this concept of financial inclusion. So I mentioned to you before that these banks won't be subject to Bank Holding Company Act exemption, and that any bank that receives insured deposits, accepts insured deposits, is automatically a bank, so subject to the Bank Holding Company Act. So we expect, and the OCC expects, that a lot of these companies will forego accepting insured deposits. They'll be uninsured banks. As such, an uninsured bank is not subject to certain laws. Among other laws that would not apply to such a bank, an uninsured bank, is the Community Reinvestment Act. And so to compensate for what the OCC believes, could be a gap, they discuss financial inclusion in their proposal. I'll be honest with you, we're not sure exactly what that means. Could be a couple of things. So it could just be the fact that, a commitment to offer your products and services, to all without discrimination in a manner that's fair and transparent, which the law already requires, or it could also entail some commitment to, for example, invest, in other entities that reach, financially disadvantaged consumers. Again, it's kind of a gray area. Our position would be that if the bank is not accepting deposits and not taking funds from a community, that they shouldn't have CRA-like requirements, but it could apply, and that's why I highlight it here in terms of defining the bank's products and services. We talked about the bullets above up to, I think, a realistic assessment of the risk. So when it comes to realistic assessment of the risk, what the OCC expects banks to do typically is to have what's called a three-line of defense compliance structure, where you've got your business folks who are the first line of defense, you've got a compliance group, and you've got an independent audit function. In addition, you typically have, to have a realistic assessment of the risk, you typically have risk mapping, where you map risk to legal, regulatory requirements and key business requirements. And then from there, you develop key risk indicators, key performance indicators. And once you have those, you have to have methodologies to make use of that information. So what else would be in the business plan? Capital plan, we talked about that, including capital levels in a liquidity crisis and from what sources that liquidity might be available. And then finally, best case, worst case scenarios. There's a lot of discussion in the proposal about stress testing, and some may think, well, we're not a systemically important financial institution, so why would that apply to us? Well, it turns out the OCC has expectations for smaller banks for stress testing, and they're also tied to capital expectations, and the bank would no doubt be responsible for incorporating those expectations into its robust business plan. Sorry, I skipped the slide there. So governance structure. So governance structure is really where your compliance management system expectations come into play. That three-line of defense compliance framework that I mentioned earlier, the risk mapping, the risk assessments, the identification of key performance indicators and so forth, the information that's provided to management and what's done with that information, all of that is part of your governance structure. One of the key things here is that bullet second from last, and that's, and I mentioned this before, it's not enough to have the information. You've got to have effective methodologies for using that information. What do you do with it is going to be a big part, I think, of those discussions that Greg referred to earlier that you might have with the OCC pre-charter. And finally, and certainly not least, you have to have a prominent role for the board of directors. The board of directors is expected to be in a position to potentially challenge management and its ideas. Therefore, it's essential for the board to receive some of that information I just referred to. So let's talk about, skipped over a slide, capital, correct? So for capital. So here, the OCC considers both, well, they're going to look at the complexity of the bank's activities and nature of the activities. Capital expectations for a payment institution are going to be vastly different than they are for a lender that keeps loans on books. As I mentioned, the OCC has a risk-based capital rule, and for those institutions, such as a payment institution, and that type of special purpose institution is common in Europe, we would expect that the capital requirement would be just a specified minimum capital amount, much like what applies to a trust bank today. In addition, they'll look at both qualitative and quantitative factors. A lot of this is discretionary, especially any amount that you're expected to maintain above and beyond the OCC's capital rule. And they'll look for again, a strategic plan. You have to be able to provide funding, not just now, but under worst-case scenarios. And so a huge part of your capital planning will be based on your stress testing, your forecasting of what contingent capital needs may arise down the road, depending on a number of factors. So now let's take a look at some key OCC guidance. Very fortunate that the OCC has published a great deal of very helpful guidance, and I would strongly encourage anyone who's considering exploring a FinTech charter to take a look at some of these bulletins that I'm highlighting here. They will give you a great idea of what you're getting into. Examination procedures are a fantastic source of guidance. In this case, I highlight both OCC and CFPB. Keep in mind that even if you're not CFPB regulated, the CFPB has the authority to interpret some of the key, for example, consumer compliance laws, Fair Credit Reporting Act, Truth in Lending Act, Equal Credit Opportunity Act. And their exam procedures explain how examiners will look for compliance with those consumer protection laws when they visit the bank. So it's very critical that you look at both OCC and CFPB procedures. I would understand the bank supervision process, both the examination process and the enforcement process. You want to know what you're getting into at the get-go and not be surprised later to learn that there are such things as civil money penalties. So study the bank supervision process. In addition, if you're either going to be in management or a director, the OCC's Director Handbook is a terrific document. It's been around for a number of years, and it is a great source of learning just what it's like to be either in management or director of a national bank. Next, I already talked about the supervisory guidance on model risk management. The next bulletin to me is a really important one, 2004-20. Risk management of new, expanded, or modified bank products and services. What it describes is the process through which the OCC expects any bank to go through when you're either issuing a new product or making material changes to an existing product or service. Among other things, it discusses things like who's to be included at the table, who's part of those discussions. They expect you to have a natural working group that's going to include representation from all the core functions of the bank that may or may not happen today in a non-bank. And another thing that's really important are expectations for testing, both pre and post. It may be different than what you're used to today, especially if speed to market has been emphasized to a large extent. The OCC believes in speed to market, but you have to do that prudently, and there's a limitation on just how speedy you can be. Greg emphasized third-party management. I also mentioned earlier this community bank stress testing. Don't be confused by the name. It doesn't just apply to community banks. It applies to any smaller institution. Next, authentication in an internet banking environment. That is one of a number of very important OCC issuances that deal with internet activities of banks, which many of these fintech firms, obviously all of them, I believe, would be internet-based, so it's very important. Regulatory capital rule. One of the things you need to really understand here is that I mentioned to you that the OCC bases the amount of capital on the type of asset. You can't have misunderstandings as to the nature of an asset, and undercapitalized could have dire consequences. So you really need to understand those rules pretty well, and that's why I have that highlighted here. And then finally, the interagency guidelines establishing information security standards, very important, covers things like expectations for third parties, data encryption. So what about examination? Now you're a national bank, so what happens now? Well, before you actually open your doors, you're going to have something called a field investigation where the examiners will come on site and perform effectively a pre-exam. Greg mentioned that earlier. And then shortly after you go in operation, about 60 days thereafter, you'll have a limited on-site exam, limited in scope. And then within about 6 months after that, they come on site and they're going to do a soup to nuts, full scope on-site examination. All banks, all national banks, are required to have at least one full scope on-site examination per year. A mature bank that's been up and running for a while, they usually have a compliance exam 1 year and a safety and soundness exam the next. For a new bank, I would expect you to have both compliance and safety and soundness exams each year for at minimum at least that first year, 3-year period when you're under that conditional approval. Keep in mind that the OCC supervisory offices have the discretion to conduct exams as frequently as they feel they need to. For any for potential or perceived deterioration in the bank's condition, matters requiring prompt attention, or perhaps they just feel that the bank is growing too fast, or we're not necessarily doing things in accordance with OCC expectations. They have that discretion to come on site at any time, and I would expect, if I'm a new bank, that they may do so. So you want to be prepared at all times to be able to Support an exam, what does that entail? It entails things like making information available to them in advance and knowing where that information is before they ask for it. So there's a lot of work that goes into understanding the exam process. This is just a slide that gives you a brief idea of what the frequency might look like. So last but not least, Rick mentioned, well, what could happen? What could go wrong here? And in doing our research and thinking about that, and we all discussed, that scenario amongst ourselves, we came across what we thought was a very good example, and it's called NextBank. NextBank, this goes back a ways. In May 1999, they became what was at the time the second only internet-only bank to receive a special purpose charter from the OCC. They were a credit card bank, and they featured a proprietary online credit application, authentication, and underwriting process that allowed an application to be processed within about 30 seconds. So it sounds a lot to me like a fintech company might have that type of application process today. Before they applied, they operated under a bank partnership model and had done so successfully for a number of years. The management team for NextBank was comprised of folks who had, in some cases, decades of experience in the credit card industry. These were not inexperienced people. Their business plan was heavily dependent on rapid asset growth. They wanted to establish a critical mass of assets in order to then, hopefully stabilize and go forward. Well, it sounds good, but it didn't last very long, because in February 2002, the OCC ordered NextBank to cease operations to prevent the bank from becoming critically undercapitalized. So what are some of the lessons to be learned here? Well, we can learn them pretty well because this turned out to be the largest bank failure in 2002. And as a result, the U.S. Office of the Inspector General did a report, a material loss review of NextBank. And so it was a great read for those folks, in my mind, who are thinking about chartering a bank as a fintech company, because some of the lessons to be learned are that, in this case, one of the core criticisms of NextBank is that they departed from their business model, that they did not stick to that 3-year business plan. They went off and veered into the subprime lending space in order to establish that critical mass that they felt they needed. But by doing that, unexpectedly to them, what happened is that, I mentioned to you, OCC capital rules are based on the quality of the asset. And so their capital needs mushroomed. NextBank did not have the ability to seek and obtain that crisis liquidity funding that the bank needed to keep going. The OCC ordered the bank, it gave them a prompt corrective action order, PCA order, to get that additional capital. When the bank was unable to do so, they were then ordered to cease and desist operations to prevent the bank from becoming critically undercapitalized. So some of the lessons to be learned here, as I mentioned earlier, you've got a 3-year business plan that you're going to be expected to adhere to. We can learn a lesson from NextBank, so can the OCC. And I would believe that the OCC is not going to be too lenient in repeating, a past error and allowing a bank to vary a great deal from its business plan commitments. In addition, this failure really focuses on the importance, critical importance, for a robust, realistic, actionable capital and liquidity funding plan. That was really at the core why NextBank ultimately failed. So lastly, some keys to success. Number one, knowledge. You need to know the application process in and out. That's why Greg spent so much time on the details. Those details are all very important. Greg mentioned going into the room with the examiners. I can tell you from past experience, having been through some chartering exercises firsthand, you're going to be going in and out of that room multiple times. It won't just be once or twice. It will probably be a series of meetings. So it's very critical that you know the process. You have to know the legal and regulatory requirements. In my mind, that should entail things like risk mapping to individual requirements, and then identifying, like I said, key risk indicators, key performance indicators, et cetera, and how all that information is going to be used. Know the OCC bulletins. I've highlighted some of them. Read them. Make sure that you understand them and you go into this with your eyes open. Along those lines, supervisory process. Key, I want to know if I'm going to be going into this, under what circumstances the OCC might issue that prompt corrective action order, or might assess civil money penalties against me as an individual, which would not be reimbursable by the bank. Next core thing, have experience. I'd want to have somebody along the ride with me that's gone through this a number of times in the past. The organizers may or may not have been bankers. Somebody along for that ride needs to know this process well and knows how to respond to requests for changes in your business plan, et cetera, because you can expect they're going to happen. And because they're going to happen, you need to have perseverance. Expect that you'll have to make some changes before you get to the finish line here. Flexibility is important. Maybe you need to do things a little differently than you thought up front. Your funding may be different, et cetera. And then finally, learning from next bank, again, criticality of financial resources. Huge that you have more than one source of funding potentially, and that those sources are such that you can describe them to the OCC in the form of a plan that you're going to have to live with.
Thank you, Mark. That was very informative and I think helpful for folks out there that are considering going down this road. And next we're going to hear from George. He's going to take us through what is this all going to cost, and if you have a bank partnership model today, does this really make sense? And so, George, take it away.
Thank you very much, Rick. So we talked a lot about the process of applying, but I'm approaching this from an entrepreneur's point of view. I've built multiple fintech companies, built an online lender, and I always looked at capital sources, cost of capital, true lender issues, and I've been looking actually at what it would take to become a bank previously, before the OCC came up with this information. So it happens that I had reached out to the Utah regulators, which is also a very popular state to create a bank in, and I've talked to executives who had started banks in the past. And the first thing that came from the regulators is they were open to creating new banks, and we started looking at how much and how long will it take to create a bank. And without having gone through the process, what multiple people have told me, and which I was able to confirm, is that roughly the process to create a bank will cost about $2 million in the creation itself. And then the regulator would expect a minimum of net capital of about $20 million. Now, these $20 million, I'm not an expert executive in banks, and I think your team has a better idea of the haircuts and the calculations, but the back of the envelope calculation, from what I found on the different sources, is that after Basel III, which is requiring a 4.5% common equity of risk-weighted assets, and of course it depends on the quality of the assets, with the $20 million in net capital, you probably can have somewhere around $450 million in risk-weighted assets on the balance sheet. These are the first two numbers. What I'm trying to achieve with this is a back-of-the-envelope calculation of what do I need to look at for resources if I want to start a bank, right? So $2 million will be my cost, sunk sum, to create a bank. Net capital will be the return on equity, and I'll need about $20 million, which means I have about this much on the balance sheet. The other part of creating a bank, and you probably all have heard this repeatedly, is the ongoing cost of compliance to have a bank, which will be on top of your existing fintech compliance probably, if at least partially. And I tried to calculate back on the envelope as well, how much would that cost? My research shows that there are about 6,000 community banks in the U.S., in other words, relatively small banks. And the total amount of money spent per year by the sum of banks is $4.5 billion. If you do the math, it turns out to be about $750,000 per bank per year. So once the bank is created up and running, this is just the cost of compliance, according to my research. The other part is that we all have heard how new rules, new regulations are coming out. Of course, there's a new administration now. It may or may not continue to go in the same direction. But for the last few years, also my research, and I have all the notes in the slide as well, shows that the cost of compliance is growing by about $100,000 per year. So what this gives us, it gives us the cost of setting up and running the bank for the first 5 years. So you have the same costs as you have right now, marketing, operations, and so on. In addition, if you do all this math for 5 years, including the setup cost, it will be $5.6 million. So this is how much you roughly, maybe it's going to be 4, maybe it's going to be 10, but roughly order of magnitude how much money it takes for the first 5 years on top of the fintech cost already. I need to compare this to the existing cost they're going to be able to shed in this structure, which is, of course, the cost of partnering with the FDIC bank. I haven't looked at the cost of the state licenses because I think they are much smaller, and the large majority of people who are looking to becoming a bank probably don't care too much about the state licenses. So according to my research and my experience in the space, most banks like Web Bank, like Cross River Bank, roughly, and I'm not here to negotiate price with them, but roughly they charge 0.5% of the origination volume as a fee. In addition, there's a monthly minimum. So if you originate $100,000 a month, they're going to charge you a monthly minimum, which will not be 0.5%. So let's assume you're big enough to not have the monthly minimums, which are in the tens of thousands, sometimes 100,000. So how much would this fee be for the bank? And let's compare it to the cost of setting up a bank. So if the cost of setting up a bank was $5.6 million, and this was 0.5%, this is 0.5% of $1.12 billion. In other words, if you originate $1.12 billion in loans and you pay 0.5% origination fee to the banks over 5 years, they will cost you the same amount of money as creating a bank. And this is the interesting part here, is that this is roughly, and with round numbers, will be $1 billion. This means that if you originate $1 billion in loans over 5 years, from a back-of-envelope quantitative order of magnitude calculation, below that is not worth to become an OCC chartered bank. Above that is probably worth it. Now, what I have not taken into account here are the other intangibles. The fact that you become independent of your bank partnership, the fact that you get over the true lender issues, the fact that you may now have access to much cheaper cost of capital, which will increase your profitability on the loans themselves. I haven't taken into account anything like volume discounts and negotiated volume discounts with your bank partners. I haven't taken into account the fact that you may need more than $20 million in net capital. And of course, all these are very rough calculations. But this is pretty much where I was trying to get with these calculations.
Well, that's very interesting, George. Thank you so much. We have a couple of questions and just a few minutes left. And I'm going to just throw this out to the panelists. And I think we covered this pretty much, but the question is, does the initial application need to address CRA requirements? And I think, as we discussed, CRA is probably not technically applicable to a fintech bank, but the OCC has indicated the need to address financial inclusion, and we're not quite sure exactly what that means yet. They requested comments on that, and we'll have to wait and see what that's all about. Average time it takes for the OCC to actually approve a fintech charter, any ideas?
Well, they haven't approved a FinTech charter per se yet, so we really wouldn't know. I know from my past experience in being involved with, organizers who were seeking a charter, it's going to take, in my mind, a minimum of between 6 months to a year before you would see an approval, conditional approval.
Okay. That is the exact same timelines I was given by the Utah regulators and the Utah teams.
Right. Okay, we have time for one last question, and then if you have other questions, you can just email them to us, and we'll get back to you. This question is, I have a FinTech client that's a Delaware corp with an official location in New York. Parent company and all staff are located in a specific country outside the U.S. Would the OCC grant it a FinTech charter, and would it be able to export Delaware interest rates and preempt? Well, I think there's a lot of aspects to this question. I think that you could end up locating the bank in Delaware and have its headquarters located in Delaware, even if the bulk of your employees were located in other states. I think it would be very difficult to have the OCC approve a bank management team that's not located in the United States. I think that would be very difficult. My colleagues are shaking their heads. So I think you would have to have the management team located in the United States to the extent that they're going to be running the bank. And with that, thank you very much for listening to us today. This program will be available on our website, pepperlaw.com, and we will send it out to those who have requested it. So thank you very much, and have a great day.